morning and welcome to Indian Open right here on BloombergQuint. It's a day when, if you look in the markets or the coronavirus updates, not the best of news, but India has had some breakthroughs and maybe that should be positive. Good morning, Devina. Suffice to say, just looking at what White House had to say with regards to deaths in US, the US markets are sulking and the Asian screen too, a bit mixed today.
Well, if you remember, we had an article by Anthony Fauci, which had already spoken about the possibility of US deaths climbing to 200,000 deaths in the US. Now you've got the White House saying that could probably, cross 100,000 to 1.24, 1,24,000 odd deaths in the US itself. But, the equity markets, it is gyrating pretty significantly. You've seen days where, the S&P 500 and Dow have had the best moves on the upside since 1993, all in a matter of 1 month. And then you've had this feeling of complete fear grip the markets as well. Yesterday's session was a damn squib compared to that in terms of volatility. Dow Jones, S&P 500, NASDAQ, they all ended lower, but the cuts were not all that severe. So about 1.8% lower for the Dow. S&P 500 was down about 1.6%. Aside from that, while we're talking about this, Nirav, I just want to look at what history has shown, particularly if you pull up the rate of change, which talks about the momentum of the price fall. It's a Bloomberg chart, and it talks about the momentum with which the prices have fallen in the past versus what it is in today's session, in this particular correction. And it looks like that 2020 and the shakeup that we've happened seems to be a blip on that parameter. If you look at between 2000 and 2004, this parameter, the rate of change parameter, actually went sub 30. That's the lower end, which talks about the ferocity of the selling and the momentum of the selling. In 2008, this went all the way down to negative 40. And now this is it's yet in the positive territory. So it's a positive 8. So if you were to look at the momentum, and even though we're talking about the ferocity of the fall, the momentum and the rate of change of momentum is still not all that high. So we probably land up seeing a little bit more in the coming few months if things worsen. But let's get in a better perspective on global equity, what investors are doing globally. Frank Benzimra of Stockton is
Devina, I just want to mention a quick perspective out here. The other bit is that while the world markets are in a bit of a tizzy, you got to keep in mind that globally guests the world over are now starting to talk about maybe some hopes of the markets having reached a bottom. Mohamed El-Arian said this in yesterday's session. JP Morgan has said this 2 days ago. And Howard Marks says that this is not a world-ending event, just that the world will end completely changed from what we have seen it in the past. So I think those are a few other things that you got to keep in mind. Do we have Frank? Because if we don't, then we should try and get in Abhimanyu Sofat, because he's with us with his thoughts as well. So let's try and connect with him to take a quick glance of how IIFL is seeing the current scenario. Abhimanyu, good having you. Thanks for joining in. How are you approaching trade right now? What is it that you're telling clients to do?
So, our view is clearly that what has happened in the market, very few companies would be there which will be net gainer from this. Most of these would be more in the pharmaceutical and the chemical companies. So something like a Divi's Lab, Deepak Nitrites, Russian Chemical, Cipla. So most of the companies from that segment is what we are liking. In terms of, where do we see the maximum deceleration in earnings, it will clearly be in companies like ONGC, BHEL, Ashok Leyland. Those are the kind of companies, plus the metal counters, where we'll see the maximum impact per se. And obviously, you have companies like PBR, Inox, where debt equity is also high. And clearly, if this lockdown prolongs, you're going to see even further impact in terms of earnings. So broadly, what we are talking to our clients is look at diversifying your portfolio out of BFSI, where you have large amount of investment, and you are clearly going to see a significant dip in ROEs, whether it is for the microfinance companies such as Credit Access, or even the banks like RBL, Indocin, and these other smaller private sector banks, plus the NBFC side. So those are the companies where it doesn't make sense right now to do the averaging part. Focus on insurance sector as well as, pharmaceutical. That is a basic theme that we have been pitching to our clients over the last 2 weeks.
Okay. We'll come back and discuss more about that with you, Abhimanyu. But time now to bring in a global perspective. We've got Frank Benzimra of Societe who's joining us right now to make sense of what's been happening in terms of the global equity market volatility and whether or not it is actually time to see the pessimism wade away a bit. Frank, thanks very much for joining us. We've got new information with regards to expectation of the casualties of coronavirus from the US. Doesn't look, like a pretty number. But aside from that, most are now, talking about how overextended this sell-off has been. And at some point when, things come under control with regards to the virus, at that point, asset classes which are completely risk-off will start seeing almost a sort of a V-shaped recovery.
Yes. So looking at the market and the market volatility, there are really three elements that we have identified for stabilization of the market. One is monetary policy providing enough liquidity. Second is a big fiscal response. And the third is to see some peak in the new number of cases, especially in the US. And the first two conditions, in our view, are being met, and the fiscal and monetary response have been actually quite impressive so far. And the market in some way has responded to this, but we need this third element. This crisis is, of course, first and foremost a public health issue, and we need to see some health solution, and we are not seeing at the moment. So now coming from today in the second quarter, it's still going to be difficult to find some bottom on the risky assets.
Frank, telling people to stay at home and causing businesses to close is almost like the economic equivalent of putting a patient into coma to facilitate curing a particular disease. But obviously, the lifeline is being provided by the Fed, and the success of this and how fast this economic crisis comes to an end will depend upon the success of the Fed and Treasury packages that they have put out for rescue. Do you feel, since they're any which ways ahead in terms of the cycle of bringing in a package like this as compared to the global financial crisis, this is going to cushion the blow a little bit better?
Yes. So we could say in some ways that the economy in the country under lockdown are in a kind of a coma. We are expecting to see in the second quarter some fall in GDP in the range of 20% in the US. So that's quite massive. But on the other hand, it's something which is really unique when you compare to other kind of recession that we had, because it is coming from the services, and we can also see that when we have some the lockdown is going to end, there will be some recovery. So that's why at the moment there is a lot of strife. If I look more specifically at the equity market, I look at a number of dimensions on the equity market. I look at the valuation, I look at the technicals, I look at the sentiment, and you have a number of indicators which starts to become green, or between amber and green. Valuation is one of them. On the liquidity and the squeeze on the liquidity that we had because of the option market really exerting some downward pressure on the cash market. The deleveraging is more or less done now, But well, the sentiment is a place where maybe you don't have still enough capitulation. So that's why we see that there is a possibility of a further bottom. But I think at this stage, what is going to be interesting and what we are advising our clients is to watch the market, to watch the valuation, and to see some of the names, some of the stock which are high quality and they are becoming affordable. And whether the lockdown is going to last for 4 weeks or 6 weeks or longer than that, there will be a time when it's going to be lifted. And when it's going to happen, you will have a lot of affordable names. The market was quite expensive, actually, in the US and in even other parts of the world. And this is now, there will be now some names that can be bought.
All right, Frank, stay safe, and thanks so much for speaking to us today at BloombergQuint.
I'm sorry, I couldn't hear well the question.
Now, I was just saying thank you for taking the time out today and speaking to us. Stay safe.
The line is quite bad.
Okay. I'll request my office to just thank him, but we'll just snap up the line here with Frank. We essentially got the message that he wanted to give. Let's try and focus on India for a bit. Lots of stocks that you need to monitor, and we want to talk to Abhimanyu about all of those. He's given his initial thesis of what should you do in the markets. First, let me get in Samit Vartak, my colleague, who will fill us in on all the key newsmakers that you should watch out for today. Samit, good morning.
Should I start?
Please, Samit, please start with the stocks in news today. Okay, I think there is a bit of a issue out here with Samit's line. We'll try and connect that as well. Abhimanyu, can I come to you for your sense on the auto sales numbers? I mean, we know that the numbers are going to be bad, but I've seen a clutch of brokerages upgrade the auto names today. Hero MotoCorp in the con call has sounded very positive about what they will do. I mean, what's happened to the clearance of the BS4 inventory as well. How do you approach the autos, and how do you look at Hero MotoCorp in particular?
वापस बंद हो गया program.
Companies like Hero MotoCorp, which are more cash rich, they are likely to do better relative to other companies because traditionally we have seen that in a bear market, and whenever there is an economic slowdown, their sales are relatively better to the competition which is there. The competition like Bajaj Auto also had a benefit of export sales, which is completely stopped right now. So from that perspective, yes, Hero could do relatively better. However, I think so, how much the slowdown will be, that is still a critical factor that one needs to look in. We are talking about somewhere close to around 20 million people, losing their jobs. So ultimately, all those are people who would be key buyers of a motorcycle. So overall, auto is not a sector that you need to be very bullish on as of now. As I mentioned, it is more on the defensive sectors where one should be looking at putting the money at this particular point of time.
So autos are one set of stocks that you should be monitoring today. What else? Before we get in Abhimanyu's views on those, Samit, if you can hear me, what are the stocks that one should watch out for in the session today?
Good morning, Niraj. On stocks to watch out for, firstly, it will be ONGC, Oil India, Gujarat Gas, IIFL, and Mahanagar Gas. And that is because India has cut the gas prices by nearly 26%, $2.39 per MMBtu starting today. The prices are now also below the BloombergQuint survey, which indicated the prices to be around $2.48. Now, lower gas prices means a negative for the producers like ONGC and Oil India, and it is majorly negative for ONGC because if you see the cost of production, gas is nearly $3.5 per barrel, and the current prices are way below in the cost of production. For city gas distribution, lower prices will be beneficial if the entire benefit is not passed on to the consumers. Also, price reduction makes gas cheaper and economical compared to other alternative fuels. So positive for city gas distribution companies and negative for the producers, that is ONGC and Oil India. Kotak Mahindra Bank, on the back of the conference call that was held yesterday post-market, and the conference call, key few highlights from the conference call were that the management is saying that if the lockdown extends for 3 months, it will lead to higher slippages and significant problems will emerge on the recovery front. Now, the bank has also not seen any flight of government deposits. And in fact, they saw deposits increasing during the Yes Bank moratorium, according to the management. Now, they're also concerned about the retail unsecured business, and they're saying that the recovery infrastructure is set up to handle up to 5 to 7% default rate. But in times like this, default rate can shoot up to 10 to 15%. That is one thing one needs to watch out for. SpiceJet, because they have implemented pay cut for all its employees. Ajay Singh, the chairman and managing director, is ready to take a pay cut of nearly 30%, while other employees based on the salary bracket are facing nearly 10 to 30% pay cut. The company also said that the employees in the lowest pay grades will remain unaffected by this decision. Jubilant Life Sciences, because they have received an EIR with voluntary action initiated status from USFDA for its solid dosage facility at USA. Hindustan Aeronautics, because they have recorded a turnover of nearly 21,000 crore rupees for financial year 2020, which shows a revenue growth of nearly 7% compared to last year. But for the fourth quarter, the revenue growth will be flat compared to last year at around 9,900 crore rupees. GE Power India, because they have been awarded a contract by NTPC to supply wet FGD systems for a value of nearly 690 crore rupees. Adani Enterprises, because they have received a letter of award from NHAI for Madhya Pradesh road project bid of around 867 crore rupees. Separately, Indocin Bank will also remain in focus because the promoter group has made full repayment of loan to Citibank, and the pledge of nearly 2.4 crore shares has been released today, that is April 1st. Also Biocon, because their insulin manufacturing facility in Malaysia has received an EIR from USFDA with voluntary action indicated, which is positive for the company. And lastly, one stock that would remain in focus, that is Indiabulls Housing Finance, on the back of a bull deal where promoter has acquired additional 0.6% stake in the company.
All right, Samit. So lots of stocks there, and Biocon in particular. This is a big positive for them. There is, it paves way for insulin glargine in the US, and I believe they were targeting sometime in the first half of next year. But that all depends on whether the US markets are open with regards to getting these kind of open for insulin glargine at that point. The other point is the banks. And Abhimanyu, before I get to our technical experts, I want your opinion on what some of these banks have been talking about in the conference calls that they've been doing. So they are seeing slippages. They are going to see asset quality deteriorate if this probably extends itself to 3 months. You've got Kotak Mahindra Bank in its recent con call also saying that slippages and significant problems will emerge if this slowdown continues for the next 3 months. How are you positioning in the financial space, and particularly some of these private sector banks which are now starting to raise these red alerts?
So first of all, I think so Kotak Mahindra Bank, they are still will do relatively better than, say, for example, an Indocin Bank. The reason for that is, for example, what we have seen is in terms of, reduction in deposit. We are clearly seeing significantly higher number for Indocin Bank at 10 to 11%, whereas the management had been talking about a number of 2 to 3% around 2 weeks back. In case of Kotak Bank, also they are not significantly exposed per se to the government business, and we have seen clearly that some amount of business being shifted from Yes Bank to them over last couple of weeks. So I feel, from a relative perspective, it is the larger banks like HDFC, like Kotak Bank, where one should see that the compression in ROEs will be relatively lower. It will be a kind of a challenging situation for banks like Indocin Bank, going forward. However, looking at where the stock has already gone to, I think so over next 2 years, if one does remain invested in the bank, considering whatever they have said, it is quite possible that they do get a price to book multiple of somewhere close to 1x, FY21. Right now they are trading at close to around 0.7x. So there is clearly a possibility of, as such, increase in price appreciation from these levels because the levels are quite low. However, I think for the short-term volatility will always be challenging for such banks.
Okay. Chandan Taparia is also joining us right now to give us a sense of what one needs to look at with regards to the index levels. Chandan, going through what's been happening within the futures and options space and the setup there, as well as the lack of volumes. Yesterday, for a change, we saw a little bit of a volume pickup in the cash market, which the turnover touched closer to 40,000, which we've not seen in some time. But what's your take on the levels now that are indicative?
Yeah, good morning. First of all, I want to talk about the India VIX. The volatility index corrected by around 10% yesterday. It was near to 65 level. So that is giving some sort of stability in the market. However, the medium-term trend is under pressure, but the daily setup indicates some sort of consolidative move could be seen. After a long time, we have started to see some put writing in the weekly and the monthly strike, and that is making some base. And in fact, the market is witnessing some buying interest at lower levels with the support of 8300 to 8400 zone. So last trading session, we have seen recovery of more than 300 points from the lower levels, and now Nifty needs to hold above 8500 zone. And if it manages to hold 8500 even after the negative opening, then we may again see a move towards 8700 to 8888 kind of level. So 8350, 8400 to 8888 is likely to be the broader trading range, and we can buy the index near to the support zone by keeping the view for an immediate bounce back move in the market.
And what about specific stocks, Chandan?
Talking about the stock ideas, we have noticed that a couple of FMCG and pharma stocks are doing well comparatively, and most of these stocks have seen the delivery buying with built up of long position and outperforming the entire market and their sector. So first trade here we are selected to be with the Hindustan Unilever, and we have noticed that in FMCG basket, this is the one of the stock which is up by around 20% on year-to-year basis, while your Nifty is down by more than 25-27%. So this stock is doing well, and we have seen buying interest in other FMCG counter, including ITC, Colpal, Nestle, Britannia. So Hindustan Unilever is outperformer and likely to outperformer going forward as per its price setup. So recommending to buy on HUL with a stop loss of 20 to 20 and expecting it to head towards a new lifetime high and move towards 24-30 kind of level. Second trade that I'm recommending on the sell side, we have seen that selling pressure is intact in most of the PSU banks, and no major recovery was seen, whether we talk about the Bank of Baroda, PNB, Canara Bank, or any other PSU bank. So PSU banks are continuously making lower top, lower bottom formation on the weekly scale, and no recovery is clearly visible in the daily scale, which indicates these stocks to go on the lower side. So recommending to sell on PNB with a stop loss of 34 and expecting it to correct by 8 to 10% and move towards 28 on the downside.
Okay, so well, viewers, that's the charts view, some trading ideas, Abhimanyu Sofat's view on some of the key newsmakers today. We will get some more views from Abhimanyu on the others, the likes of Biocon, the likes of city gas distributors. But it's also important to take stock of what the quarter gone by has been. For Dow, it's been the worst. For India too, 45 out of the 50 Nifty stocks, I think, have had a terrible one, if not all. Darshan Johnson with a few charts that show what the quarter's been like. Darshan.
Yeah, hi Niraj, good morning. Basically, if you're looking at it, we're down 29% for this year, for this quarter itself. It's the 1st of April today. So, and if you take a look at the entire year, we were down 26%. So majority of the knock for our indices came in the last quarter, and that too the last month, because the selling has intensified. It's been close to a 30% drop on a YTD basis for the Nifty and the bank for the Sensex. But it's been even worse for the Nifty Bank, which is down 40%, which is pretty much in line with what the mid-cap and the small-cap end of the market have done. Now, basically, if you're looking at the performance, the gainers, as you pointed out, only 5 of them managed to give positive returns. And out of them, these 5 include Nestle, Bharti Airtel, HUL, Dr. Reddy's, and Asian Paints, and all of them have reasons of their own, given the fact that the lockdown and how stocks are getting cleared out. A couple of these FMCG companies did see a lot of buying. Dr. Reddy's has good news of its own in terms of what it's doing for the pharma space. Asian Paints, surprisingly, is up in trade. The big drag came in Indocin Bank, given the fact that what's happened in some of the banks and the liquidity concerns, despite the management clarifying. The deposits have actually moved up significantly. The outflows have moved up significantly, and Indocin Bank is down almost 80% for the year. Z because of promoter problems. Vedanta and Vedanta actually all the businesses that it has in commodities and oil have faced a hit. Tata Motors, the China issue, and M&M because of the rural slowdown. Similar was the case with Sensex. Only 4 of them out of the 30 managed to gain. Kotak Mahindra Bank was the 5th one that did well, but that was down 3%. And among the Nifty Bank, take a look at some of the banks. Indocin Bank down 80, RBL Bank down 60%, IDFC First, Bandhan Bank is now trading below the IPO price. So overall, an extremely weak set of numbers. So FY20 pretty much will be a year that most of the investors and traders would want to forget.
You sure do want to forget it, Darshan. Thanks very much for bringing this to us. But getting back to our market conversation, Chandan, just come in on the pharma space. I want to talk about the pharma space, and the recent news for Biocon also seems to be optically positive. The VAI the inspection getting closed down in the Malaysia unit paves way for insulin glargine. Is it a big positive? Do you feel that, considering the price corrections that the stock has already seen, there is room left on the upside?
Yeah, in fact, we have a positive view on most of the pharma companies, and Nifty Pharma Index has formed the bottom and negated its lower top, lower bottom on the daily and the weekly scale. And it has also taken support at the previous key support trend line. So most of the pharma stocks looks quite good comparatively, even in this scenario. So Divi's Lab and Dr. Reddy are the two counter, Ajanta Pharma is the other. And now talking about the Biocon, this stock has also formed the base. Couple of days back, the stock has seen a strong recovery, but in line with the market, it also witnessed some sort of volatility. And I believe that 262 is likely to act as a support, and because of that, this stock can again move towards the recent swing high of 291 and then rally towards 300 kind of level.
Okay. Activity was also pretty predominant in the FMCG basket yesterday. Stocks like HUL, Britannia, Nestle, these are the names. Asian Paints now back towards 1700 from levels of about closer to 2000 from which it corrected. So no major correction for this one as well. Abhimanyu, getting your take on the next leaders of the rally that happens. Now, considering that consumption as a pocket is really not corrected as much, do you think that they could actually fall behind once we start seeing some stability and the market starts to move up?
So obviously, you could see at that particular point of time a kind of a sectoral rotation happening that cannot be negated. Having said that, I think so some of the companies from the sector, clearly the fast-moving products, like what Britannia produces or some of the products which HUL produces, we are going to see a significant improvement and kind of a pre-buying kind thing happening with a lot of those products over next couple of weeks. So from that perspective, I think so, if you're holding these stocks, doesn't make sense to sell and buy another stock where you're not sure, what will be the impact of the slowdown going forward. So I would say if you have these stocks, and some of these stocks have corrected a lot, I would say ITC has corrected a lot, which is not typically of...
Abhimanyu, sorry, we'll just have to come back to you. We've just put the pre-open on your screen, so the Nifty 50 opens marginally negative, with the Sensex showing you a 1% pop on the upside. A few stocks that you need to keep in mind before we head into our conversation again. Keeping Z is the top loser right now. There are some media reports suggesting that Indocin Bank is invoking some of its pledged shares of Z, and the stock's down about 10%. BPCL is down about 5%, UPL, HCL Tech down again another 3% apiece. HDFC Limited is 3.5% lower, ICICI Bank 2.5% lower, GAIL, Bajaj Finance, Bajaj Auto, Asian Paints, it's down about 1% in the session. Your worst performance BPCL, but remember yesterday energy stocks did really well. What's gaining is Indocin Bank. Remember the promoter entity that's, they've gone ahead and they have prepaid. They're debt free now. They've prepaid, they've gone ahead and cleared their loans with Citi, and therefore, and now the stock seems to have a relatively lesser overhang in that aspect. Reliance Industries 3% higher, Britannia's up 1.5%, ITC, HDFC Bank in the green margin ahead of the auto sales numbers for March is up 1%. Bajaj Finserv, Infosys, Grasim, Kotak Mahindra Bank are also doing well in the session. So all in all, a muted start, but a positive one nonetheless, not looking all that bad either.
I just want to see what the city gas distribution stocks are doing and Biocon are doing. Those are the two that we should just monitor for a minute, and then of course we'll let the pre-open rate settle and then probably talk more about those. So those are the two sets of stocks that you have to monitor in the session today, aside of course the large caps. So IGL, MGL and Gujarat Gas on the city gas distribution side, as well as Biocon because of this Glargine news, and it paves the way at least, and therefore that's a stock that could be really interesting in the session today. So you've got to monitor both of those pockets. But Abhimanyu, I don't think we've spoken about the city gas distribution stocks as yet. At least IGL started off unchanged in the pre-open. Maybe it'll change a bit, but what's the thesis at IIFL? Do you think the cost will not be passed on and therefore there could be material benefits to a company like IGL or Mahanagar Gas?
So I think so, most of the cost reduction has to pass on. I don't see a reason why there would not be a pass on of that. So I would say that, from a sector perspective, we do like Gujarat Gas, and that has more to do with, what's happening in Morbi. But structurally, we see going forward, a shift happening where, like, for example, for Middle East, we've seen that ceramics, now people are looking at buying it from India rather than from China. So that will benefit companies like Gujarat Gas. Overall, I think so from a valuation perspective, some of these stocks like Petronet, LNG and all have come down. In terms of city gas distribution, yes, the sensitivity of the sector is low relative to some of the other sectors. But what we have heard about, some amount of reduction in demand that we have seen in case of Delhi, which could impact companies like IGL. So I would say that, if you ask me from a preference perspective, then we would be more bullish on company like Gujarat Gas. Then it would be Mahanagar, then Petronet LNG, and then Indraprastha Gas.
Okay. But interesting moves that some of these stocks had in trade yesterday, particularly IGL. Let's watch out. How did you analyze Biocon's news, Abhimanyu? It seems net positive, but is the market ready to take on or buy into companies lock, stock, barrel on positive news in the current setup?
So in case of Biocon, what we estimate is that considering what has happened, we are clearly expecting close to around a 8.5% improvement in EBIT in FY21. Stock has already, if you look at from relative to where the stock was earlier, the stock has been kind of, languishing as such. I would say that going forward, it is one of the better stocks to invest in because clearly the interest in the biotechnology sector and, their work they do on biosimilars, that is likely to get appreciated more. And with this Malaysian facility, getting approved, clearly there could be some traction in this stock going forward.
That's Biocon there. Chandan, I want to come to you on, since we were already talking about banks, the PSG lot and SBI in particular. The stock reached 350 in its prime, came right now down to about 195, which what it's trading at currently. Is it looking like you could see some bit of a technical bounce on the stock and therefore maybe from a short-term period can look at buying it?
See, first, if I talk about the Nifty PSU Bank, that PSU Bank index is trading at their lifetime low, and this is down by more than 50% in this year and down by more than 30% in this month. And mainly talking about the SBI, this stock, however, witnessed some sort of consolidation in the last trading session. But this is also making lower top, lower bottom on the weekly scale. So as of now, it may see some bounce because of its multiple support of 176, 180 zone. But again, upside hurdles are being placed near to 220 kind of level. So those who are looking to play the bounce back can look at 220 by putting support near to 175 zone. So this is the only counter. If it recovers, then may see recovery. Otherwise, most of the other PSU looks weak only.
Okay. PSUs as a whole are not looking as great, but if at all there has to be a recovery, the first candidate would be SBI. Aside from that, a few other names, and Chandan, talk to you about some of these. They are not new listings anymore. They got listed last year. It's almost a year since listing now for most of them. IndiaMar Intermesh, IRCTC, IIFL, and I'll throw in a Polycab as well. Any of these.
When I talk about the IRCTC, this stock has seen the strong momentum earlier, but due to the market fall and the lockdown in the nation, this stock also seen the sharp correction by more than 50% from high levels. It made the high near to 2000 odd levels and corrected to 774. So I think again it provides a good opportunity at lower levels, those who are looking to go with the investment kind of scenario, because this concept is likely to do well comparatively, and e-commerce business will be back once the concern over the coronavirus and the lockdown will normal in the nation. So I think at current zone, the IRCT provides good stability and the opportunity. And when the stock was moving up, everyone was hurried to buy, and I think this is a good time to again pick this counter when it is trading at 50% discount to higher level. So I think 850 is the immediate support, and the stock has potential to go to us 1300 to 1400 kind of level as per the short duration of the price pattern. To discuss about the InfoAs and the FL, Info has also taken support at the lower band, and this also come to the e-commerce category. This stock has taken support near to 1580 zone, and now the immediate support is going to be at 1850, and here also we may see swing to us 2300 kind of level. So I think most of these stocks which corrected from higher levels would see some stability, and one can definitely look at to adding the portfolio in this counter.
Okay. Quick thoughts from Nirav, Chheda as well, Johnson right now. Nirav, we'll get to the index in a bit, but since we are talking about stocks, let's start off with the stock recommendations that you have for our viewers today.
Yeah. Good morning to everyone. There are two stocks which I particularly feel are going to be weak. I believe Infosys has witnessed a head and shoulder breakdown, and the peculiarity of head and shoulder is the retest happened. The retest has happened around the 660 odd levels, and I believe Infosys is now headed lower. A lot of shorts have been built in the last 2 days. I believe this stock can go down towards the 600 or probably again the 540 odd levels. So, from a trading perspective, looks like 645, 650 is a good level to short at where it is right now. The stop loss for the same should be 662, and the possible target can be 610 for about a day or two. The second one is a sell call on MFSL. Even MFSL, there is a breakdown which has happened after a long time that 420 levels had been broken down. The retest happened in the last week, and I believe again the stock is headed lower. The stock can again go down towards the 300 odd levels. So, one can short at current levels and, on rise up to about 380, 390. The stop loss for the same should be around 400, and the possible target for 1 to 2 day perspective can be 365.
Okay. So those are some ideas from Nirav, Chheda as well. The other question, I think we spoke about some of these newer listings and how they are doing. Abhimanyu, Sofat, I want to throw in one more there because there's a lot of queries around the retail viewers, at least about what to do with the SBI cards, simply because a lot of people subscribe to it as well. The stock is, of course, below the pricing at which it was issued. Is it providing an entry point, or would you hesitate currently?
So first of all, I think so it will take some time for the company to recover in terms of its business, because I think so there could be some cases where people don't pay their credit card as whatever money that they need to pay in terms of, so collection is going to be a challenge for SBI cards. Yes, they will continue to show accrued interest, but cash flow is what I would be critically looking for. Coming at, from a pricing perspective and where the stock was expected to be and where it's right now trading at close to around 625 or something. I think so, somewhere close to around a 50,000 crore market cap. It's a very decent company to look at. So probably I'm looking at around a 14% kind of a lower price from current levels, where I think so far the risk reward in buying this particular stock looks quite attractive to me. So that is what I'll be waiting for before, we need to recommend clients to invest in the company. Because from my perspective, I think so the NPA levels might increase going forward for the company because of the lockdown.
Right. No, and also Abhimanyu, just wanted to get a follow up on that. A lot of talk about how unsecured loans that could probably see repayments getting pushed back or slippages increasing is mainly in the cards business. So in light of that, is it possible that SBI cards, even at a market value of 50,000, maybe wait it out till you see at least 1 or 2 quarters of results for SBI post this entire lockdown fiasco?
So first of all, I think what has happened is there's been kind of a confusion in terms of the entire RBI announcement. Clearly what the RBI has said is that interest cost will continue, but you cannot charge additional interest cost because no one is making payment for a 3-month period starting 1st of March. And as a result of that, there might be some tendency of some people to not pay up on their credit card bills. So if people do pay up later on, most of the card companies charge interest rate of between 36 to 42% on a yearly basis. If that is the kind of interest that they will make because people have a cash flow issue. So there's some advantage that these companies would also have because large part of the income that is generated is from customers who don't pay money on time. At the same time, there will be people who will not pay at all and there could be some increase in default rate. So I don't think so you need to be worried that everyone who has a credit card, considering that, it ultimately impacts your CIBIL score. And I feel that, large part of population will still continue to make their repayments because of the high interest cost. So I think so this valuation of close to 50,000 crore will be justified. Let's wait and see, what happens in case of June quarter before we can assess whether the call has gone right or wrong.
Yeah. All right. We've got a minute left to go for market opening. So I want to quickly get in those top calls from our technical experts. Chandan, let me come to you first.
Yeah, so like we discussed about the 2 stocks, first the buy idea on Hindustan Unilever. We have a positive view and set up on the same and expecting it to move towards the new high territory. So recommending to buy with stop loss of 22.20 for an upside target towards 24.30. And second is a sell on the PNB where we are expecting a further decline. So one can sell on a small bounce with a stop loss of 34 for the downside target towards 28.
All right. And Nirav, what's your top call?
Yep. I think Infosys as a stock has performed pretty well up till now, but it is one stock which I believe is likely to fall further. So this is going to be the top call where I believe this stock might just underperform all the other stocks at this point of time. So, shorting this would be a good idea. I believe 500 is going to come. So, one can start.
Okay. Gentlemen, thanks for your ideas. Let's start getting in the market open in a moment. We should start off marginally lower. Maybe the pre-open rates seem to suggest that we'll start off lower. The question is, will this last? Okay, I think the rates have started now. So let's mark the indices about 0.2% lower. Nothing dramatic, just about any other day, which is actually good to see because most days nowadays, we've actually had a start which is about a couple of percentage in the green or a couple of percentage in the red. This is a bit of an unusual situation that we find ourselves in today. What's correcting? Bharti Infratel is down about 3.5%. There is weakness in ONGC, that should be the case because of the gas prices being revised lower. Kotak Bank, I think people have not taken too kindly the call. They have mentioned amongst other things that if the lockdown lasts for more than a month, then the slippages could rise quite significantly. State Bank of India too is actually following suit, and Bharti Airtel corrects a bit in the session today after falling in trade yesterday. But ONGC is your sore spot, down about 3.5%. One name that I would want to talk to Abhimanyu Sofat about before we thank him is Indocin Bank, up about 3.5 or 4%. They have repaid the pledges to Citibank Mauritius, and I think that's the reason why Indocin Bank, after having a very dull day in trade yesterday, is bouncing back a little bit. Let's see if this gets sold into or does it stay put. HDFC is the other one which has just moved up a little bit. So those are a few names, at least from the large cap that I'm talking about, the only names in the green worth talking about. On the downside, I mean, oil has spiked quite considerably, so BPCL and the likes too have taken a bit of a nosedive after the move yesterday. But Kotak Bank and ONGC are the top losers, Devina.
Right, and let's just quickly also take a look at what's been happening in the broader market space. I mean, for one, the news for Biocon was a positive. I'm assuming that the stocks open with gains in today's session, but a whole host of other stocks which are in the red. But market breadth this morning seems to be pretty flat. There's not much of a divergence, but you still have big losses coming into the likes of a Yes Bank. This one is, picture perfect to describe volatility. The stock and a trader's play. The stock went up all the way to 80, 83. From there, it's come back down to 20 rupees. Future group stocks completely decimated. Future retail, future consumer, future lifestyle, everything, lower circuit in today's session. You've got the likes of Societe, which is down 5%. Hathway Cable, that's looking weak. Oil India is looking weak, about 3%. Kaplan Point, Equitas, NIIT Tech are some of your other losers. Ujjivan Financial Services, again, looking weak this morning. What's doing well is the likes of some of these sugar names. Balrampur Chini is up about 5%. Delta Corp is up again. That's another one that's up 5%. Remember, has been beaten down quite badly. Godrej Consumer is up. Edelweiss is up at 40 now. So from lows of, I think, 33, 34, the stock has managed to pull back. Jubilant Life, that's up about 4% from a logistics. Scient, 4% higher. Biocon, like we said, is already 3% higher. Godrej Properties, see some bit of a recovery. And remember, this one has moved into the futures and options segment as well from this series. So there are futures of Godrej Properties available for trade. Spark is up 2.5%. That's doing well. Then you have the likes of BF Utilities and Bajaj Hindustan also. Decline.
Yeah.
583 stocks trade in the green.
Yeah, some good names out there. But very quickly, before we get in Samit Vartak, one quick thought, before we thank you on the show today, Chandan, quick opening thoughts, any stock that stands out for you?
See, talking about the Nifty, it's down by around 100%. Volatility is also down by 1%. So I think a couple of pharma stocks could be on focus, and we were talking about pharma and FMCG, and I think Biocon can be taken here. If you look at the price behavior, the stock opened positive, managed to respect the support of 268, 270. There is the previous swing low. So I think by putting support of 268, one can look at for move towards 291 kind of levels.
Okay. Nirav, Chheda, very quickly, your index strategy, we haven't taken that. Are you initiating a fresh shot?
Yes, definitely. I believe below the 8550 levels, the index is likely to witness further selling. Very likely index might come down towards the 8300, 8200 odd band. So definitely I'm a seller here. I'll be selling index with a stop loss of around 8900. We're already about 1% down, so it was yesterday's rates. 8900 is a good stop loss. Now probably 8750 should be the stop loss, with index being 8500. I believe 8300, 8200 is coming.
Okay, gentlemen, both of you, thank you so much for joining in today and giving us your thoughts. Really appreciate your time. Abhimanyu, before we thank you, like I mentioned, just wanted to quickly talk to you about Indocin Bank. What are your thoughts there? It's a stock which is getting a lot of bad news, but this morning they've spoken about releasing the pledges, which is probably a small overhang gone. How do you approach this one?
Sure. As I said earlier, what we clearly are seeing is that this particular year going forward, which is FY21, we see that probably the earnings are going to decelerate by close to around 35%. Looking at that, the stock is trading at 0.7 price to book. What is the key reason why when you should be looking at buying the stock would be one, which as you mentioned, that the promoters have reduced their pledge. Second thing now important is that the promoters have talked about increasing their stake in the company, and they've written to RBI. So if they are able to increase their stake in the company, I think so that would be something that will be clearly taken quite positively by the market. Until unless that happens, I think so the volatility in the stock will remain in the current market situation. Valuations are quite cheap in the company, but I think the confidence building is the critical thing which needs to happen in this particular stock.
Okay. We leave it at that, gentlemen. It was great chatting with all of you this morning, Abhimanyu, Nirav, as well as Chandan. Thank you very much. All right, next is a conversation that most of you would have been waiting for. A man who gives sound advice and whose advice you would really want to turn to in such tumultuous times. Samit Vartak, founder and chief investment officer at SageOne Investment Advisors. He's joining us right now with his thoughts. Samit, thanks very much for taking out the time. Difficult times. And these difficult times require some bit of hand-holding, at least for the retail end of the investment chain. Right now, what have you made out of the complete fear that has gripped the market, and the fact that in a period of 1 month, there have been times where you've gone from fear to FOMO, which is the markets have soared as well, and they've completely gone down to troughs too?
Yes. Good morning, Neeraj and Devina. Good to be here. It is, I think, one of the most hysterical, period that I have seen in my life. I lived through the 1999, 2000 kind of .com, and then the crash, and then 2008 and 9 kind of crash. But this has been so sudden and so fast and furious that it's been almost impossible to react to this. So, I think what is adding to the fear this time is that not only is there a fear of economic slowdown or almost a collapse, but you see a lot of things around you, physically, health-wise. There are so many things you're worried in your real life. It does add to the fear psychosis, and that's something which hasn't happened at least in our lifetime. So I think that is where there is extreme volatility, because there is no way the uncertainty is so much that there's no way to evaluate what is going to be the impact, of this. But, I want to put a little perspective, on this. I think where this is different than what we have seen in the past. Even if you look at, say, the Great Depression that was in 1929 and, which lasted for 3 to 4 years. And to get the highs of 1929, it took until 1954 for the Dow Jones to recover the lost ground. So it was a humongous loss of wealth during that time. But I think what was different at that time was that the Fed took a lot of time to react. They did not help at all. And at the same time, the government increased the taxes. So the economy was almost left hanging, and it was almost the first time that it was happening, at such an extent. And the Federal Reserve, the central banks, were not equipped to do that. From that learning, I think they were able to reasonably well manage the 2008 kind of crisis of what not exactly to do. Something that they didn't do in 1929 and something that Japan didn't do in 1989 post that. So that is where Fed came in 2008-9. Again, in 2008, I think the big difference was that they wanted to set examples. There were a lot of political issues, whether to help Wall Street or not. They took a lot of time, from January to September, to react, because the general public was against Wall Street. And hence, once Lehman Brothers collapsed in September, that's when everyone got together and then they acted. I think this time it's a little different. This time there is no opposition to helping any industry, at least in the Western world. So I think they have been very quick to respond to this, and they will not, I think, let go anyone down, because it's not anyone's fault. It's a natural disaster, and they have unlimited balance sheet, because dollar, it's compared to countries like India, where you are worried about your currency, the US doesn't worry about their currency. So they have unlimited balance sheet, and that is something which an investor has to take it into cognizance, that the reaction of the central government as well as the government will be significantly smoother and faster, and they will do whatever it takes to safeguard the economy as well as the financial system, because it's the financial sector that is what is the real worry in the world, in India as well as across the world. And that is something which I'm pretty sure about the Western world. I'm not so sure about India.
Actually, that's a very good point, because the response time, Samit, versus the global financial crisis has been extremely fast and extremely quick. And the overall improvement will mainly be a result of the success of the Fed and Treasury packages of rescue and stimulus. Keeping all of these factors in mind, and the fact that we've already come off so sharply, Samit, how do you place valuations? Do you think that there is a possibility that you could see further deterioration in valuations? Because we are already, if you take a look at India valuations itself, we're now below the 15-year mean.
Yeah, so I think, see, there are two things that an investor needs to worry about today. One is valuation, and another one is what will happen in the longer run to the businesses. It's fairly reasonable to evaluate businesses and what will happen to the businesses, but valuation is we have seen in the recent past, right? I mean, something which like the leading NBFC, where everyone thought that it's untouchable, the valuations will stay at that 8-9 times price to book, suddenly comes down by 50-60%, and it just takes one event. There is a lot of comfort that a lot of investors get through recency bias, that the recent 7-8 years of high valuation, people extrapolate that to permanency. I think that's where the trap is. I mean, it's not just one example, but just look at the examples of Eicher, Page Industries, Havells, KRBL, Kajaria, VIP, I mean, Marico, Godrej Consumer, Maruti. There are so many of these highly valued companies which have not even just half, but some of them have come down by almost 70-80% in terms of valuation. So that's a risk that someone has to be aware of. When you look at the structure of BSE 500 today, the top 100 companies are still trading at a trailing multiple of 21 times, even after such a big fall. But as you go down the line, even if you just look at the bottom 100 companies in the BSE 500, they're all trading in single digits, so 6-7 times multiple. So you have a universe which, if you go away from the top, say 100 or 200 companies, trading at the valuations of the depth of the financial crisis in 2009, whereas many of these highly valued companies are still, I think, retaining that valuation, and it just takes one black swan event to just puncture these kind of valuations. So I think investors do need to be concerned and worried about, not extrapolating what's happened in a couple of companies like an HDFC Bank or an Asian Paints in the last 20 years is going to happen in many of these companies which have only seen maybe one cycle.
Well, that's an interesting point that you make, Samit, and I would want to dwell on that a bit. But just tell me then, are you advocating that if people are making fresh allocations, and are you making fresh allocations right now, or are you biding your time? And if you are indeed making fresh allocations in your portfolio, how are you managing the portfolio? Are you putting in companies from that bottom half of the NSE 500, which are quality names but trading at valuations around the global financial crisis?
Yes, Niraj, I think that's a really good question. I think the big problem is, when someone asks you whether you are adding, most investors do not have the fresh capital. Most of them are fully invested, and that itself has taken a beating of 30-40%. And so, what do you do right now? So, of course, if you were lucky enough that you took a call of getting in cash before this crisis started, or at the start of this crisis, when we took some call and we raised some 20% cash, that money I'm definitely starting to deploy, because the valuation that you see, once the valuations hit the attractive point, the stocks will find reasons to bounce. And same thing happens the other way around. If the valuations are high, by some magic, the stock market tend to find some reason. It could be a black swan event or something else. It's easy to see that in hindsight. So it's very difficult to time once the valuations are attractive, and they're attractive because there is so much of uncertainty. And as I said, this is not comparable to any of the previous crises. This is a very short-term event where the actions of the government and the Federal Reserve are going to be very, very smooth. Now the question is, what does an investor who is fully invested do? I think this is an excellent time where many of us have been holding at least few laggards, where that these are not great companies, but you just couldn't get out because they have taken a hit. Now you have an opportunity where really good quality, excellent companies, whether it's in the small cap or mid cap or large caps, are down 50-60%. And this is a time to just get out, just forget about what prices you bought those businesses at. If you do not like the businesses, get out of those businesses and put that money into these great quality businesses. You will thank yourself for just redesigning your portfolio at this point in time. And you would think that generally you get paralyzed, that you don't want to even look at your portfolio, but just get active, get out of the poor quality businesses, whatever valuation they are at, do not have any kind of anchoring bias, and get into really good quality businesses which have corrected a lot.
Okay. Well, that's sound advice, and I think something similar we had spoken about the last time that we spoke on Alpha Moguls as well with Samit, but I think the timing wasn't conducive then. Maybe the timing is really conducive right now. So Samit, let's try and now talk about some of these businesses. One is businesses which are available at good valuations, but before that, where are, in your assessment, which are the businesses that will escape, and I'm using my terms very carefully, escape relatively untouched by the current crisis? Have you been able to try and identify some in your wisdom?
Sure. So see, I think it's this is really tricky, because in this case, we don't know how the situation will evolve and how the world will sort of adjust itself to the post-corona reality. So there are two ways I think you can look at it. So again, as I said, one thing is, which are the businesses which may come back to normal, but the valuations are permanently hit. So I believe that unsecured lending, where the valuations of 8-9 times, we have seen in the recent past, that's history. Even if those businesses come back to their previous strength, I don't think the valuations will come back to those 8-9 times. That's history. Where I feel so you need to differentiate between those businesses which will maybe come back, but valuations also will come back. So I think the spaces like specialty chemicals, contract manufacturing, entertainment, the cinemas, I think the strong airlines, those are the businesses which will definitely come back. The secondary impact of this is, how do we adjust as a world? Whether this experience of 1 month of working from home, whether it will maybe trigger companies to cut costs, and this becomes a little more permanent kind of a working situation. Not all, but they can reduce the fixed assets related to their businesses and allow more employees to work from home. Reduce the travel, rather than traveling, do video conferencing, because once you experience, you get a lot of comfort, and then you tend to continue those for a longer time. So in that situation, maybe we would need better connectivity, better networks. So something which is, the telecom ancillary space may see a huge jump, but you don't know whether these are. It's better to be late in identifying such trends than be too early, because you may take an impulsive call that, okay, a simple example like hand sanitizer. If you think that there is going to be a lot of demand for that, but as an investment, that may not turn out to be a great decision, because there is no barrier to entry in manufacturing hand sanitizer. You have to identify things which will pick up post this crisis ends, but also make sure that there will be only one or two companies who can do that. Not that anyone and everyone can get into those businesses, because that's where I think a lot of investors get into a trap that if there is no barrier to entry, whatever the demand is, it can go up 10x or 20x. There is no economics left, and there is no returns left for an investor.
Got it. Samit, the other half is companies which may not necessarily get back to peak valuations, something that you started off with, but that the valuations have been decimated so much that just a normal mean reversion, not to peak, but to some normalcy, will bring gains as well, because the business is good. There is a valuation de-rating that has just been too substantial. Are there pockets like these? Would unsecured lenders be a part of that?
I think I would rather focus on the secured lenders in that space rather than unsecured lending, because almost everyone is equally hit. Definitely that will come back, because I think once this, it's highly possible that we look back at this event as the highest hysteria that we have seen. It may not really turn out to be the risk that we are assuming today. And in that case, a lot of businesses will immediately go back to the normal. The life will go back to normal in a moment. Suddenly if there is a cure which is found, or suddenly a vaccine is found. So I think that's where the FOMO kind of thing, where Davina started with, is coming. But it's important to realize what were extremely overvalued, even if they have come down by 50 or 60% in terms of valuations, those are still expensive, because historically such overvaluations only last for one cycle, and in the next cycle such overvaluation doesn't come back. I'm sure there will be other sectors where you will see such overvaluations, but I think it's better to focus on investments where you see the businesses coming back, as well as the valuations are well below fair valuations, and they just come back to the fair valuation. Not the businesses where they're already come back from overvaluations to fair valuations, and maybe the businesses will come back to normal. I think that's not where you will make extraordinary returns. This is an opportunity of a lifetime where you will be able to identify great businesses which are trading at half or 1/3 of the fair valuation, and it's better to go there rather than bet on someone where it's already just at fair valuation.
Yeah. Right. Samit, the other question would remain is, in times of fear and adversity, that's the time, the brave get rewarded with disproportionate profits. And disproportionate profits is what I'm referring to from a mid-cap and the small-cap side of the market standpoint. They've completely given up the 2017 rally that brought the mid-caps and small-caps to these levels. At any point in time in this correction, did you feel that it was, maybe of value to look within the broader market space? Because sticking to quality is something everybody does. Everybody has spoken about it. Everybody has said that, while you are seeing this correction, there is going to be business continuity. The larger names are not going to run out of business. So therefore, this is just a small blip in the overall growth story for the larger names. But it seems like mid caps, small caps, where there are good value businesses, are sort of shunned away.
Right. I think that quality list is, by every event is shrinking, by the day. In a matter of 3 weeks, I'm pretty sure there are many businesses which seem quality are out of that quality basket now, and will probably never get back into the quality basket. So I think, this is an opportunity where you get extremely cheap valuation. See, this large cap, small cap, mid cap has been a differentiation mainly in this cycle. It's really never been that differentiation in the previous cycles. It was phenomenon of this cycle mainly because a lot of technical issues, SEBI triggered and all of that. But I think focus on the great businesses. There are so many of these mid cap and small cap companies which are in these 2,000 to 10,000 kind of a range, where they are extreme, almost monopolies. They are leaders. The difference between their business compared to the second player is much higher than, say, an Asian Paint and then the second player, or an HDFC Bank and then the second player. So those are the businesses where this crisis has actually triggered collapse of the competition even more than what had happened even before. And those companies, when the economy comes back, they have such a huge opportunity to gain market share that the growth that they can, accomplish would be very, very high. Even if the economy grows at 3% or 4%, their growth rate can easily go beyond 25%. And those are the businesses which are, where you can expect that they will double their earnings in the next 3 years. And at the same time, their valuations, if they double their earnings in those 3 years, will go up 2 or 3x. And that is the opportunity I think one should look for. It is not that often that you get such opportunities to pick the leaders in certain industries. And there are so many of such companies available today.
Samit, one last question before we wind this up. Any advice to retail investors on how to, if they want to build a fresh portfolio, if they want to churn an existing portfolio, if they want to rebalance, what is the advice?
Yeah, so, again, as I said, I think every investor has laggards in his portfolio. I'm not saying laggards in terms of prices, laggards in terms of the quality of businesses. By holding them for last 2 years or 3 years, I think one definitely knows which are those, few companies. Just get out of those companies. Identify, 4 or 5 of great leaders in small or mid cap or wherever you think, you are comfortable, and you realize that these are really strong businesses which have weathered through not only the 2017-18 kind of, slowdown, but also this Corona crisis, and get into those businesses. They may not have fallen as much as, say, 70-80% that many of the other businesses which have fallen, but there are many which have fallen by 50-60% and are trading at well below the fair value. Those companies, there are many such companies which will, look at companies which will double their earnings in the next 3 years. If that happens, most of those companies will at least double their valuation. And that's the opportunity you have to make up 4 to 6x kind of money in the next 3 years. And it may seem really bleak at this point in time, but these things can turn in a dime. If you haven't been lucky enough to get into cash, forget about it. What happened in the past is past. Don't be guilty about it. Just see what is the best you can do looking forward. And once you do that, things can change in a very fast time. You can recover whatever money you lost in the next, very foreseeable future. Do not get anchored to the same stocks and just, based on your emotions, try to make up the money in the same stocks. It's better to move on to the stronger stocks and let go of your, weekly.
That's really sound advice, Samit. Thanks very much. I'm sure all our viewers have taken a lot out of this interview. Thank you so much for joining us this morning.
According to a recent report, women today contribute nearly 74% of real estate buying decisions.